Hi everyone, I am Adriana Lopes and this is Connected, the podcast of Nova Economics Club. On this episode, our guest is Professor Ricardo Reis, a well-known economist in the macroeconomics field and professor at London School of Economics. In 2020, starting in March, the US deficit has started rising swiftly, in such a way that in August it had tripled in comparison to 2019. In parallel, in the euro area, the government deficit has risen strongly, reaching 5% of the GDP in September. Fiscal policy is associated with government spending to either stimulate a sluggish economy or contract an overheated economy. In this context, the expansion of fiscal policy was motivated to substitute household consumption, prevent further job losses, and provide liquidity to firms. Such an expansionary fiscal policy might have side effects such as crowding out, which results in firms having difficulties to finance their activities since the government resorts to the markets to finance the debt, reducing the funds available to the firms. Welcome, Professor. Thank you for joining us today.
Pleasure to be here. Thank you, Adriana, for the invitation.
So, in fact, governments around the world have run up huge fiscal deficits to face the 2020 crisis, and at the same time, unemployment has remained high, whereas inflation and interest rates have been low. Do you think that there is scope for further fiscal spendings without triggering inflation or crowding out private investment?
Now, as you well noted, there's been very large fiscal deficits in 2020 associated with not just the automatic fall in tax revenues as a result of the recession, but especially as a result of very large stimulus packages, which included both tax cuts, but especially very large transfers towards people. These actions, these fiscal policies, were very justified, mostly as a relief spending given a very large shock. We had a lockdown of the economy, a freezing of economic activity as a result of the pandemic, and one that affected people very differently. So even though it was an aggregate shock, it had very heterogeneous impacts. It is very difficult for private markets to respond to such an event, and the government rightly steps in by being able to borrow from the nation, or in this case even the economy as a whole from the future, and provide relief for different people in order to make sure that, or in order to try to minimize the long-run scars and more generally the pain and suffering that results from that fall economic activity. But the key word here, Adriana, is that this was relief, this was support, this was social insurance. Yes, there was also an element of stimulus, but that stimulus consisted not of a traditional stimulus of pushing up for aggregate demand in itself, but rather for, given again the heterogeneous impact that the crisis had on different sectors, to be able to replace demand, to replace incomes, more even than demand, in different sectors in order to make sure that we didn't have complete, let's say, failures of some sectors in the input-output network, input-output network that characterizes economies. Okay. So this was mostly relief, not really stimulus, relief and replacement of demand in different sectors. Now, this is what we did, and then you asked me, well, but unemployment is still high. Well, yes, but the shock is still here, meaning we still have a pandemic, we still have a virus, and we still have associated restrictions to free trade, as well as, in their more extreme version, lockdowns. Why does unemployment remain high and inflation low? Because we continue to be locked down or restricted in our ability to trade. There's nothing, it's very hard to imagine a world in which a fiscal package could be effective, large, but even well targeted enough to prevent us from being in a recession right now. Of course we're in a recession because we're still living with the virus. A more pressing question, though, is that now that, certainly in the UK and the US, and let's pray Europe gets its act together and hopefully not in a too distant future in Portugal, we are going to be removing the restrictions to trade, the restrictions to work, the restrictions to move around.
That seems to be the case already in the US. There's already some states where all restrictions have been removed. And in the UK, it's happening very fast, such that over the next month and a half to 2 months, life will be truly back to normal insofar as no fear of the virus or of the pandemic. Now, in those circumstances, the economy will reopen. That's when we'll see the extent to which unemployment falls, inflation rises, and interest rates rise. But, whereas unemployment and inflation will only see it then, interest rates we can see already, because being financial markets, they are forward-looking. And what have we seen in the last month and a half in the US? An increase of more than 100 basis points in long-term interest rates, an increase in expected inflation that likewise is around the 100 basis points so far. So we're already seeing that those increases happen as soon as, of course, you are able to reopen the economy. Reopening the economy is the key, more than the fiscal package in itself. It's about is it that you will reopen and how safely you will do it. Finally, you ask, but is there scope for further fiscal spending? Sure there is. You can always do more. Certainly the United States is doing a gigantic amount more. Is that too much? Is that too little? Well, that's a very big question, a hard question. But you asked me whether that increase, if it ends up to being too big or too small, is that an increase that's going to lead to triggering inflation, was the word you used, if I remember. Well, I'm not sure inflation would be my major concern right now. I'm more worried about the fact that you will be stimulating the economy to the point where you'll be using up the fiscal space that you might want for the future, that you are accumulating a lot of debt with very little multipliers. I wouldn't go as far as saying that the multipliers are negative. Yes, there's going to be some crowding out of investment, and there's going to be some increase in demand, but because of that crowding out, I don't think the multipliers are going to be all that big. And as a result, I'm more worried that you're using up fiscal space that may be more valuable for either for future structural investments or for future recession. Inflation, well, we'll see. That's not something that I think is in danger for 2021. It's a different question if you're telling me about 2022 or 23. There, I do worry that certainly in the US and in the UK, but also with some hints in Europe is sadly very behind on this. What you're seeing is that central banks that are as dovish as we've had in a very long time, very willing to tolerate high inflation, and very confident, in my view, overconfident, that if inflation rises, they will be able to tame it down, of which I'm considerably more skeptical.
The Economic and Monetary Union was launched in 1992, representing a coordination in the monetary policy with the introduction of the common currency, the euro. National fiscal policies are still subject to fixed constraints designed to prevent any undermining of the stable money objective, such as the excessive deficits procedure that sets reference values for national budget deficits, 3% of GDP, and overall public debt, 60% of GDP. In fact, these constraints leave the burden of adjusting for country-specific factors to follow national fiscal policies, which, with complete autonomy, could put at risk the conduct of monetary policy. Therefore, the question of coordination of fiscal policy has arisen to complement the monetary policy. And in what concerns to the future of the fiscal policy, do you think that fiscal policy could be somehow coordinated internationally so that it could be more effective around the world? And for instance, about Europe, do you think that European members should be more united under the fiscal regulations?
I'm not sure. First of all, in the last 6-9 months, I wouldn't say that coordination was at all the problem. After all, the tide turned on everyone, so we're all swimming in the same direction. Some a little stronger, some a little weaker, but that had to do with the strength of your legs or your training beforehand, if you want, the fiscal space you have, your state capacity. So I'm not sure that I would put coordination very high up in my list of big concerns in the last year or even in the next 6 months. I think sometimes there's an overemphasis driven by the European Union. Understandably, the guys who coordinate things in Brussels always think you should coordinate more, but I'm not sure that coordination was really all that was missing in the last few months. In the future, I think the coordination when it comes to the euro area, a big concern is that sometimes what's good for the union as a whole is not what's good to individual countries. I think we had an element of that in the early 2010s when I think a little more fiscal expansion in Germany would have been useful, but it was not in the strict interest of Germany individually. Will that happen in the next year and a half? Let's see. I mean, I think in that sense it depends a lot. Again, going back to when the constitution of lockdown happens in different countries and how different countries recover at different paces. But since we're a little bit far from that, I would, for now at least, not really be asking the question. I'm much more worried about us reopening our economies in Europe, about us vaccinating people in a, forget coordinated, fast way in order for them to worry about the economy and fiscal policy. For instance, talking again about coordination, I certainly would have preferred if in Portugal we had coordinated less with the EU, and instead of doing the foolish choices that Brussels did, we would have bought more vaccine. We would be buying all the AstraZeneca vaccines that all the countries now are saying they want to refuse giving it. I would rather have an uncoordinated response where Portugal would be more like the UK and would just worry about vaccinating its population more, as opposed to this uber egalitarian view that has come from Brussels and has just led to us now being months and months behind on reopening relative to, say, the US or the UK. So coordination can be very bad if it's coordinating on doing badly. And that's, I think, what's been the history of the vaccination campaign in the last 5 months.
The zero lower bound reduced the margin of maneuver of central banks, since low or close to zero interest rates have not been stimulating economic growth. Even with the implementation of quantitative easing, which aimed at reducing the interest rates below zero, economic growth has been stagnated. This unconventional measure has lost some efficiency, leaving central banks with fewer tools to influence economic growth. As a result, there is more room of maneuver for fiscal policies. There are the automatic stabilizers, which are movements in public spending and revenues due to economic fluctuations, without explicit triggers. However, it has been brought to light semi-automatic stabilizers, which are targeted taxes or spending measures that are triggered if, for instance, the output growth rate declines below a specified threshold. And still about the future of fiscal policy, is there an effective necessity of a revolution, let's put it that way, of the fiscal policy? Will this require that unconventional monetary policy needs, in a way, to be complemented with a new era of unconventional fiscal policy tools, such as semi-automatic stabilizers, for instance?
I'm not a big fan of the word revolution. It's certainly the case that we have done a lot of study, a lot of research in economics when it comes to how to best design fiscal policy. And at the same time, the world has changed, as it always is changing, and therefore merits somewhat different policies. But over the last 10 years, 20 years, if I went down to Brussels, Berlin, Lisbon, or Washington, or London, and told them about how research and the facts would require change, mostly, for the most part, there was an enormous amount of inertia, which is a natural institution in politics, and so it makes sense that now we'd observe some of those changes. What are those? You already pointed to the use more of some form of automatic stabilizers. I think that's something that economists have been discussing for a very long time. I think it's to be noted that automatic stabilizers sometimes is a word that is misused. I mean, I think there's one part of automatic stabilizers is the extent to which some programs that are micro programs that depend on micro parameters, unemployment insurance being one, it depends on whether you're unemployed or not, and that happen to, when we're in a recession, more people qualify. More people simply are unemployed, and therefore there's more payment on unemployment insurance. That's the automatic stabilizer we have already right now. We could potentially do, I think, a much better job if we had some of the triggers having to do with poverty and the wider program, especially of anti-poverty programs. But there's another part of automatic stabilizers that is used, I think, sometimes not in the best way, which is, we should have more rules that extend the unemployment insurance generosity or duration, or simply trigger transfers or government spending whenever we enter a recession. On that and on the following of rules, I'm not quite as confident that actually the case for them is better now than it was before. And why? What have we seen exactly in the last 9 months? The opposite of rules, but rather a gigantic amount of discretion. Was that a bad idea? No, not necessarily. We had an unprecedented shock, and indeed we needed to design new policies. Rules are a good idea when you have plain vanilla garden variety shocks. The case for rules is a case, if you want, between 1999 and 2008, where we're having recessions of a certain type for which you could design good rules. This recession is actually such an unusual one that a rule that automatically would have expanded this or that program would probably have been a bad rule, right? What we needed now was very different policies that had to do with layoff schemes, had to do with replacement of income. For instance, unemployment insurance played almost no role in Europe because nobody got fired almost. It was all about, it was very different. Imagine we had a rule, an automatic stabilizer. Most of the things we did in the last 9 months, we wouldn't have done. That doesn't seem like the right thing to do. So I'm not sure the case in that sense is stronger than it was before. Different though, and the big change in the world is that countries, because of the fall in real interest rates that's been going on now for a while, maybe 15 years and 2 decades, certainly for the last 10 years, the case for more debt has been higher, more outstanding public debt, or less cost of having higher debt, one. And two, the fact that fiscal policy has been running, let's say, somewhat better in the sense of a macro perspective, and central banks have been more limited in their ability to intervene, has also recovered the idea that we should use not just monetary policy, but also fiscal policy to fight recessions. That fiscal policy should be much more active in counter-cyclical stabilization policy. So, if you combine these, having more automatic stabilizers in the micro sense I said, being able to live with more debt, and having fiscal policy take on a bigger role in counter-cyclical stabilization, if you call all three of these a revolution, then yes, I agree with what you said. We should have more of a revolution in the sense that we have to adapt to them. At the same time, these are not outlandish concepts, and that change was coming in the first place. Finally, you asked me about unconventional monetary policy complemented with unconventional fiscal policy. Here I'm a little less sure, just insofar as I think I generally am not a big fan anymore of the word unconventional monetary policy. And why, Adriana? Think about the ECB. The ECB is an institution that is now, what, 22 years old. What you call unconventional monetary policy, say quantitative easing, negative interest rates, large balance sheet, and the satiation of the market for reserves, have all been true for, depending on which one, 10 to 13 years. More than half of the life of the ECB has been doing unconventional monetary policy. I think words have to catch up to reality. We should just call it conventional monetary policy, normal monetary policy. That's what it is. What is unconventional, what is weird, is the things we were doing back in 2005. We were doing them because the world was not the same world in which we live in today.
In order to maintain price stability, central banks around the world had to resort to several unconventional instruments to bring inflation back to a level that is consistent with our medium-term inflation aim. To succeed, central banks need to bring the real interest rate, that is, the nominal interest rate adjusted for inflation, below what is called the real equilibrium interest rate, the rate at which all factors of production are at full capacity and inflation is stable. However, it is not within the power of the central bank to change the structural conditions that would turn around the trend of the real equilibrium interest rate. That call for higher equilibrium interest rates can be directed at governments and legislators, combined with the urgent demand for measures to strengthen the potential growth of our economies. And starting last year, ECB has launched a strategy review due to some events, not only the pandemic crisis, but also the historically low interest rates and also the limits to lower those interest rates. How do you see a possible coordination between monetary and fiscal policies in the next strategy review of ECB? And in your case that you're not in favor of such a coordination, what about the future of the monetary policy in that strategy review?
So first of all, note, I didn't say I was not in favor of coordination. I said I didn't like calling it unconventional monetary policy. But actually, you're right. I'm not that much in favor of so much coordination. But that's not what I said before. It is what I will say now in some ways. Look, I think the fact that monetary and fiscal policy together determine macroeconomic outcomes is one of the great lessons that your listeners there in Nova should have taken from their macroeconomics general equilibrium classes. the idea that we can have a monetary policy that's completely independent from fiscal policy, and that state of affairs would lead to better macro outcomes, is generally not the case in most well-specified general equilibrium models. Monetary policy affects fiscal policy affects monetary policy. They pursue goals that are similar. We need to always think about the interaction between them. At the same time, we learn painstakingly through experience, as well as through very important and relevant, I think, economic theory and evidence, that having a fiscal authority that dominates the monetary authority can lead to very bad outcomes when it comes to high inflation. And so giving independence to a central bank such that in the pursuit of its mandate, it uses monetary tools in a very, very narrowly defined way to pursue an inflation objective can often be a good thing and a better thing to do. Now, that is, I think, a certain state of affairs. That is a state of affairs that the evidence is not in any way, or the pandemic said, is a terrible idea. However, there are some changes to that state of affairs. First of all, is that it is the case, certainly, that because of the limitations that the central bank has to stimulate economic activity, as I said earlier, fiscal policy should now be more activist, more devoted to countercyclical policy. The idea that the central bank can both, one, control inflation, and two, reduce the amplitude of the business cycle is one that now is harder to accomplish. Central bank can still control inflation, but being the only macro policy in charge of making recessions less painful and making booms last longer, that is one that is no longer possible. But no, this does not require coordination per se. It just says that the fiscal policy has to start doing its job instead of just sitting on the side and waiting for the central bank to do everything. That's the first point. It's not coordination, but it does mean that having complementary objectives, fiscal policy and monetary policy should be swimming in the same direction. So that's one point. A second point here is, with the pandemic and the increase in debt, we are in a very subtle equilibrium or state of affairs between the monetary and the fiscal policy. In the short run, it is the job of a central bank, when there's a gigantic increase in fiscal spending and issuance of debt, to facilitate the placement of that debt in order to preserve financial stability. In other words, for the central bank to intervene in public debt markets in order to prevent a public debt crisis that results from this very sudden shock. Both fiscal and monetary policy have to work together in this process of borrowing from the future in order to respond to this aggregate shock, as I was telling you 20 minutes ago. The central banks have done so, and have done so well, as they should, as happens in wars. Monetary and fiscal policy, monetary authority has to intervene in public debt markets. In the case of Europe, if the ECB hadn't, we'd be having a gigantic crisis, probably starting in Italy with the sovereign debt market. But that support should be temporary and should be very quickly unwound by the central bank. For otherwise, what is temporary support very quickly becomes monetary financing, as again history teaches us. That ability to transition out is going to be a very large challenge for the ECB and other central banks. It is one of perhaps the main questions on whether inflation, as we were talking earlier, is on the horizon or not for 2022-23. When I told you, maybe inflation is there, I don't think 2021. I think the risks here are 22, 23, 24, 25, which is the extent to which the central bank can escape from being the supporter of public debt markets. I'm a little bit pessimistic about the US, given recent developments there. I think for the ECB, let's say I'm still hopeful that it will be able to do that relatively well. Again, this is a coordinating now with the idea of this coordinating stopping in the future, and as a result, a strategy review. I'm not sure whether it should just say what the path for that is in the future versus not. So that's, I think, a second point in which, well, coordination, I guess, yes, in the short run, we already had it, but moving to the future is more the decoupling, the divorcing, if you want, of the two. Finally, thirdly, and importantly, there is one element in which there is coordination needed between a central bank and a fiscal authority, and that is when we think about the role of the central bank as a lender of last resort to financial institutions that are illiquid but solvent, because when those institutions go from being illiquid and solvent to becoming insolvent, at some point the central bank has to call the Ministry of Finance and say, this is now in your court. There's always coordination. There's never a sense in which a central bank can lend very large amounts to a bank when there's a risk that bank will go into receivership or fail without in coordination with the Ministry of Finance. Certainly in Portugal, we've had the experience of that. between 2014-15, where the actions of the Bank of Portugal or the ECB certainly then had left a very large bill for the Portuguese taxpayer to pay. And so there's no sense in which they should behave completely independently. Now, that coordination may become relevant in the next couple of years, insofar as we have lots of insolvencies, and especially that drag into a financial crisis that does not seem to be in the horizon right now, but if it does, absolutely, it is important that there is a very strict coordination. So, to conclude, first, in pursuing its inflation goal, no coordination needed, simply having fiscal policy do its work. In supporting public debt markets, coordination in the last few months, not true in the next few years. In dealing with financial stability, yes, coordination, absolutely necessary now.
So we are reaching the end of the episode, and once again, thank you, Professor, for joining us today.
No, thank you.
And thank you to all of you who are listening. We hope you liked it, and see you in the next episode. Stay connected.